Hello, everybody. My name is Paul Hopkins, and I'm the VP of Investments here at CPI Capital. And in this video, I'm going to do a deep dive into my underwriting on our new acquisition called Atlas at Lewisville. Atlas at Lewisville is a 150-unit apartment building located in Lewisville, Texas, which is in the Dallas-Fort Worth area. So before I get into it, just want to highlight these disclosures and talk about forward-looking statements or financial outlooks. These are projections and not guaranteed results. So, I do my underwriting based on all available data and information that's out there, whether it is public or private, whether we have to pay a subscription to receive some of this information or not. But, we're putting together the best available material for our underwriting. And my analysis that I do, I'm very transparent in how we analyze things and how we look at things. This is what this video is for. It's to show you what I'm thinking and how I evaluate the deal, and basically how I'm able to get the projections. So, with that being said, yes, this is our team. So I'm the VP of Investments here at CPI Capital, along with my partners, August Biniaz, Ava Benisaki, and Josh Melanchuk, who is the head of our investor relations. So there's a little bit about our portfolio and our current track record. So let me talk about the investment summary. So this is a stabilized cash flowing asset, 1985, that we're acquiring below replacement costs in the previous owner's basis. We're doing a very light touch value add, which is 35 remaining classic units that we're renovating, plus taking the existing units that have already been renovated and bringing them to market level renovations. And then we also have underwritten it with conservative fixed rate CMBS debt, locked in at around 6%. We're buying this basically, at the trough of the DFW supply cycle. During the webinar, we will dive deep into this theory and this analysis, and present this case into why now is the right time to invest into DFW. This is a Class B workforce housing property that's basically insulated from the Class A pipeline that's concentrated in other markets that are on the outskirts of DFW. And of course, DFW is the number one metro for in-migration, 5-year job growth, and a very diversified employment base. So we're buying this at 153,000 a unit. The going in cap rate is at 5.8, and our assumed exit cap is at 5.5. So the DFW population is at 8.5. And basically, like in the webinar, we talk about the supply decline, and it has declined roughly 48% from its peak in 2024 to today. So why we love this deal, we're buying it at 153,000 a unit, which is roughly 174,000 a unit all in, including all our CapEx, versus the estimated 250,000 replacement costs, and below the prior owner's all-in basis of 196 a unit. So it is a stabilized cash flow property, occupied, income producing, and we're doing a light value add touch to this, and I'll get into those details in my underwriting. So we are entering the cycle at the right time in DFW, and we've also structured in conservative debt assumptions. This is, it's a multifamily value add garden style property located in Lewisville, which is in the Flower Mound submarket in Denton County in the greater Dallas MSA. 150 units built in 1985, sitting on 6.3 acres. We're buying it at 23 million. Our going in cap is at 5.8, and we're holding it for 5 years. And these are the investor returns. at 15.2% IRR, 18.5% average annualized return, and a 1.93 equity multiple. The average cash on cash is at 5.97, and the preferred return is at 8%. Okay, now that I've kind of covered the investment summary and details, let me get into our underwriting. So this is a proprietary underwriting model that we have built over the last couple of years and continue to stress test it and use it. I continue to refine it to make slight tweaks here and there, and making sure that it is continuing to actually work in the means and methods that we intend it to. So quite confident in our underwriting models and how I built it and the returns that we're getting. Um, you could actually take the information that I'm sharing today and you can plug it into any model, and you're going to get slightly different results, and that's okay. Underwriting is an art form. It's not an exact science. But as long as the underwriting model that you're using uses the standard, uh, basically financial kind of assumptions and calculations. Anyways, I'm going to go through all that today, just to show you how we built it, how it works, and how we're able to get your projections. So, not all models are the same, but they should be producing very, very similar results. So this is basically the project summary, where I talk about, what the overview of the project is. I just described that on the PowerPoint presentation. And our acquisition basis, our disposition details, and the return summary. Along with the sources and uses and basically our operating projections over the 5 years. So, yeah, if we look at basically the year-over-year growth, I have a better output summary here that kind of explains it in more detail. So you can see here, this is the T12. This is currently what's in place on the last T12. So to kind of give you some more background, what I do is I actually take the trailing T12, and then this is up till March. We do have the May financials as well, and the property is actually continuing to perform really well, even though the seller's condition, the seller is being forced to sell by the lender, and because they purchased this property at the peak of the market, put a lot of money into it. They were also on bridge debt. They basically came to the end of the term of their bridge debt, and were no longer able to meet the covenants that were set within their agreement. So, but anyways, so this is basically where I start. I take the T12 that's been offered to us, and I plug it all in. So this is all the raw data, straight from their T12 that I basically plug into my underwriting model. And I go through and I categorize the line items here. So I look at, what is the gross potential rents. So these are my drop down menus that I categorize the income or expenses for. So I go through each line, categorizing, the gross potential rents, the loss to lease, bad debt, vacancies, looking at the additional income items, miscellaneous income, RUBS, utilities, all this um, breakdown. And then I go through all the expenses, looking at management fees, advertising and promotion, administrative, payroll, repairs and maintenance, and so on. So this is where I start, and I basically plug in the information and just kind of look at the overall performance. Um, we are also in today's standards using AI for a lot of support. We're not using AI to replace what we do, but we use AI to help accelerate some of our analysis and also to identify some of the flags that should be looked into. And so I took actually the T12 and I ran it through basically my AI modeling, and I also built a skill within AI to, how to evaluate T12s and the rent roll, and producing really good kind of results and analysis. So, basically, for example, I'll just throw this up here. This is the report that it has given me, kind of an executive summary of looking at trends, revenue performance. And, this is instantaneous. So, like, what would normally take me, a day to kind of go through this and start to build my notes, and looking at, these red flags, I've built the skill to identify these flags and provide me with the outcomes. So, you know, that's where I basically start my analysis. And then that's where I start to dig into some of these flags with the broker, during the initial underwriting. And so this is all done pre-contract, a letter of intent. So, a lot of this information probably has been most likely been cleared up through our conversations with the broker and our own due diligence and digging into it and kind of making some initial tweaks. But this is, one of the ways that we are using AI. And it's quite fascinating, the level of detail and um, the items that it catches. So, items requiring explanation. So, what's a gain to loss and uh, scheduled rents and things like this. So, this is what we went through. Started talking to the brokers and property managers about these informations and validating certain things and stress testing certain things. So, anyways, I just wanted to share that background with you, that this is how we're using AI to help us, as a tool, to be more efficient. So, anyways, after I kind of go through and I categorize everything, I look at the top here, and this is similar results that AI produces. It shows me, the vacancy and how this property has been performing, and you can see that that the vacancy, it did go up to like 10%, 11% in September, October, but then it came back down. So this property is actually, from a health perspective, performing well as far as the vacancy. Loss to lease is very minimal. There was, you could see some spikes here that has happened in January and February, and then come back down. Looking into those items, delinquencies, and then concessions. What's been offering here on this property. So you can see, because of the loss to lease and happening basically in December and January, that the concessions were also higher during those months, trying to fill those units potentially back up, if there was any issues there with maybe lease renewals or things like that. Um, and so those are some of the flags that we look into. Why all of a sudden is there a loss to lease for these 2 months, and is the concessions that are being offered in a reflection to that? So, we look into those issues. And then scrolling over, what I do is I take the unadjusted numbers and then annualize figures, looking at it from a T12 perspective, T6, T3, and a T1. Are we performing better over if you look at the T12 versus the T6 versus the T3 versus the T1, you would hope to see that there's an increase of, so say net rent, which is kind of reflected here. Yes, there is an increase from the T12 to the T3 to the T1. That's a good sign. We look at effective gross. It is also increasing. That's a good sign. That's just showing that this property is starting to perform better, as in the last few months on an annualized basis. Looking at the operating expenses. Operating expenses have come down. Now, this can be taken out of context, because it depends on how insurance is escrowed and how taxes are escrowed. So that's something to kind of look at and investigate. The overall performance. But on the surface, they've been able to reduce their expenses, and that's great. And then an increase in the NOI from 1.3 to 1.4. So going in cap rate, so we're buying it at a 5.8 at a going in cap rate on the T12. But if you look at the T3 and the T1, it's actually at a 6.25 or a 6.36. So we're actually performing better, in the more recent months on an annualized basis. So that's great news. And then we look at, how's the property performing from a RUBS perspective. So this is an opportunity that we see and that we've taken advantage of in the underwriting. So looking at the RUBS, they're only taking 71% of the available expenses that are being charged back to the tenants. Usually this should be up to like 90. So we could be more aggressive on collecting those uh, utility, utility fees back, and getting this up to 90. So right there's an opportunity that I see just from looking at the T12 and seeing what we could do there. So, anyways, once the T12 has been entered here, it migrates into my underwriting model. So this is my full-on underwriting model where I put all my inputs. And if I click the button here, it takes me down to the pro forma. So you can see here, as of April 1st, so I've got the T12 and the T3 that are shown here in these columns, showing me the total gross potential rents, our economic losses in summary for the T3 and the T12. And this column here is our year one pro forma. What do we think this property is going to receive for revenue or its operating expenses? So if you just look at it right here, just on the surface, the T12 at 2.1 million, on the T3 2.16, so it's slightly better. And then on my year one pro forma, I'm actually showing less, mainly because if you look at the total economic loss here, they're seeing about an 8.6% total economic loss, and I bring it up to 16, mainly because of the renovation vacancy, which I'll go over shortly. So there's an additional $150,000 that I'm accounting for during renovations, which is 6.2% that's adding into this total economic loss. So, that $150,000, that's, taking that, adding that into the 2 million here, that brings us, almost in line with the T12 and the T3. So that's where the majority of that's coming from. And then, so now we get into other income. And what I like to do, uh, well, let me finish this thought and I'll come back to this. But so you can see the T12, the T3 here, and the pro forma, the effective gross income. So my effective gross is actually less than what's currently there. So this is a good sign in the underwriting that we're not going overly aggressive in year one, and letting things kind of season out, and then things improve from there. Okay, so uh, then we look at basically our total operating expenses, 1.1 million versus the 1.05 for the, so it's coming down from the T12 to the T3, and then I'm assuming more in our first year. So that's also another good sign for basically underwriting and showing that it's a little bit more on the conservative side. So looking at the net operating income, 1.3 for the T12, 1.4 on the T3, and I'm at 1.2 at the end of our year one. So I'm $100,000 less in year one on NOI. I'm also factoring in here the replacement reserves, which is a lender requirement that we set aside $250 per unit per year for deferred maintenance items that they want addressed. So that that does affect the overall NOI, and it's debatable whether or not that that should be above the line or below the line. But I've included it above the line, above NOI, and so that shows that our going in cap rate on the on the year one pro forma is at 5.3 versus the 5.8. So, we're being a lot more aggressive. Looking at the operating expenses, 47%, 43, and 49%. So going back to the input summary here, sorry, I kind of did jump around there, but you can see the T12 potential rents, and then our year one, year two, year three, all the way to year five. Our effective gross income 2.5, that dip in the first year and then climbing back up. Uh, and then you can see here the year over year increase. So, a dip of 8% and then climbing up 32%. I'll explain why that's such a big jump in a little bit. And then tapering back down to 7 and 3%. Looking at our overall cap rates, so 5.8 going in, year one is at 5.3, and then grows up to 7, almost all the way up to 8 in year five. As far as the debt, we've got a 1.29 x, and the minimum for this property is at 1.25, or 1.2. And you can see that we do have a dip in year one. That's mainly because of the vacancy renovations, which is shown here. Renovation vacancy, sorry, at 6.3. And then yeah, so our yield on cost is at 5.1, dipping down to 4.6, and then climbing back up. Our break-even occupancy, it shows at 88% based on the T12. And this basically is showing us like what our occupancy can get down to in order to still meet the DSCR requirements and the loan to value requirements that are basically set up by our lender. It does come up. That's mainly driven by the renovation vacancy and the loss in income, and the dip in operating income. But then it comes right back down 79%. This is very healthy for year two and beyond. So it keeps going lower. So overall economic loss, the current loss to lease is 1.4, and I'm assuming zero. I'll explain that further in the underwriting video, why I choose zero. Physical vacancy at 8.3, and I'm taking it down to basically 6.1. It's how it's calculating. Renovation vacancy, so it's going to take us basically 2 years to do our renovation. So you'll see a higher vacancy in year one, tapering down in year two, and then flattening out from there. Concessions, during our due diligence and actually doing property tours, the concessions that are being offered on all the comps and this property have stopped. That's a sign that the market is turning, and that they're able to start increasing rents, which is a positive sign that it's a growing economy. And it had a lot to do with the supply wave that hit the DFW market, and we covered that a lot in the webinar. So I encourage you to watch that webinar to see more details about that. But anyways, concessions have come down, and I bring it to 0.5%. We have one model unit that we're going to be using for future tenants, and then collection losses, keeping it at 0.5%. Other income, I'll talk about operating expenses. I'll talk about and the overall NOI. Let me get into that. Before I jump into that, I want to talk about the affordability. And one thing that we're cognizant of is one, pushing out the tenants with the renovations and the increase in other income items. We want to make sure that we're not pushing the boundary on the existing tenants in this market. So we look at the affordability test, and so we take the median household income of 81,000, and the affordability is basically 1/3 of your paycheck is going to be going to rent. That's kind of like the threshold that you want to see. But looking at what's in place versus our 5 year, you can see that it's very healthy. We're still 4.3 multiple at the end of the day, where a minimum should be at a 3 multiple. So the affordability is still there. We're not getting overly aggressive for this market or for the tenant type. Okay, so now going back to the inputs, let's drive through basically the inputs here, just so I can show you the overall structure on everything. So this is basically the project information where I enter in the project details. This is the acquisition, a summary. So we're buying it at 23 million. Supposed to close at the end of July. This is a current market cap 5.6%, and this is taken straight from CoStar. So if you look at CoStar's cap rates here, we're currently sitting at about 5.7 to 5.6, 5.6 trailing. So this is kind of roughly where the market is that around that 5.6 for this property. And so that's what I've entered in here. CoStar report, shows X73. So that's taking that right from X73 right here. And that is 5.639 for 2027. So that's the market. That's taken from CoStar. Now, do keep in mind, CoStar is not a perfect system. And especially in Texas, which Texas is a non-disclosure state. So the transactions of properties aren't disclosed, on public records. So CoStar does its best job to basically reach out to the current property owners, see what the property was purchased for, and then it enters in that information based on what the information it was told. So it doesn't, because Texas is non-disclosure, that can't necessarily be verified or fact-checked. So this is going off of the information that it can best obtain. Sometimes it's always best to get the information from brokers because brokers have the inside information on a lot of these trades. And so the actual cap rates can be less or more, but based on conversations with some of the brokers, I believe it's a little bit less than the 5.6. So that's giving us the reason why we feel that our exit cap is really at a 5.5. We're buying this also at a discount at 5.8. So that's because this is a lender sale. So we're buying it at a discount. The seller needs to sell. And then I actually have a sales comp study that I did that shows that the actual cap rate is much higher. So let me actually pull that up. So analysis, sales comps. Let me pull. Did a whole presentation on this. So, looking at basically an entire uh, sales over the last 2 years, and our purchase price at 153 at 5.8. Looking at the North DFW corridor, we're basically 8% below the trades that have happened at 166 unit. So we looked at a total of 57 trades that have happened from 2024 to 2026. And if I take that actually a little bit step further here, Atlas at Lewisville is 153. The North DFW corridor medians at 166, all 57 trades. So you're mixing in like all different neighborhoods. So in the lower rent submarket neighborhoods as well. So like I've bifurcated it. But when you look at the North Corridor where this property sits and its true comps, showing at 166 and we're at a 153, so we're basically at an 8% below market. Even looking at the cap rates, the North DFW corridor sitting at 5.5%. So this is information straight from the broker. And taking basically all the properties that have sold in that corridor at 5.5. All 57 comps that we have the information on, and this is information that's provided to us strict right from the broker. I also did another analysis from another broker who's given me information, and they've provided me these comps here. So basically, looking at the weighted averages of all the properties, and the comps that this broker provided me was 157. We're at 153 units, so we're still below. And look at sorry, that should say 5.8 there, and the weighted averages of all the available comps is at 5.56. So still buying it at a pretty good discount. Okay, so then looking at so here's where we enter in our acquisition fee, 3% of purchase price, and our asset management fee of 2% of effective gross income. Total equity required is at 8.9. And you'll notice here that it says 100% is coming from the limited partner and 0% from CPI Capital. The reason that is that's by design. That's intentional because we as GPs want our money to basically not receive any preferred treatment. Our equity is treated just as equal as the limited partners. So this here in my model is if I wanted to actually treat the GP equity different. And so I've got GP and co-GP, separate waterfalls here, is if, saying that the GP uh, equity was treated differently, but it's not. In this case, all the GP equity is treated equal to the LPs, and so that's why it's shown this way. So, and then we've set up an 8% preferred rate of return, and these are basically our promote structures. So anything from 8% to 15%, it's a 70-30 split. From anything from 15% up, it's going to be a 50-50 split. Now, this is where I enter in the information about the unit mix. So all this information that you see here is actually pulled from the rent roll. So from the rent roll, I have entered in basically the latest rent roll. This is the line in the sand that we drew for our underwriting and our pitch decks and our PPMs. And so the rent roll that was used was from April. We do have updated rent rolls from May and June, and performance is actually still looking really good. But what I do is I basically paste in all the available information on the rent roll into this model here. And what this does is it basically summarizes all the unit types, the unique unit types, the number of units, beds, baths, total square foot, and looks at everything that's vacant, does a search, looks for everything that's within this model, count if. So using very dynamic formulas within this spreadsheet to basically pull out the information. And then coming out to what's the total market rent, what's the available rent. So that's calculating basically the vacancy loss. And then I break it down even further. I look at averages, what's the average in place for each of our unit types. And so you can see here we have 6 unit types. Basically, there's 3 unit types, but like I said, there are 115 renovated units. So there's 47 renovated. That's what the R designation means in this model. So 47 Aspens have been renovated, 16 Tahoes have been renovated, and 52 Vales have been renovated. So this takes the averages for all those units, and then this looks at the max and mins of what's being collected. Another thing that I like to look at is the length of residency. How long have these tenants been actually living here for? So you can see that there's 14% that is basically within the first year, 55% from 1 to 3 years. That's really good. 3 to 5, 13%, 5 to 10. And you can see there's actually been some tenants here that have been here for a long time. So, it's, 15 to 20 years. So just looking at anything over 10 years, you're looking at 12 um, tenants that have been there. Other things that I like to look at within this model is basically the total market rents increase, what these can be increased to, average rent if increased to market upon lease. So these are just a different analysis that are kind of done in here. And then I look at the lease expirations. Where's the bulk of the leases within the cycle. So you can see that there's a lot of leases that have expired basically in month one here. Month one is shown as August. So that's something that we need to pay attention to, that there's going to be a lot of leases renewing um, or these tenants vacating. So we need to be careful of that when we take over on a new property. And that's a plan with our property manager, seeing that there's 15 lease renewals that are happening in that month. We need to address that, give the current tenants there some comfort that we're not here to disrupt the property, we want to kind of maintain that relationship. And so another reason that I look at this is to determine how quickly we can do renovations and mark to market our properties. So if I go back here, this is where I basically enter in the data for the rent roll. It kind of goes through an initial pass of an analysis, and then here's where it basically summarizes everything. So let me expand this, unhide. So you can see here, this basically summarizes everything, what's in place, what the market rent is, and then this gives me the everything that you kind of see here in blue is what we change or manipulate or enter in. So it summarizes everything in place. I double check the market rents. So 1284 is the average in place rents at $1.60. Market, the market is basically determined by the current property manager, not by us. So this is totally arbitrary. Whatever I change here does not affect the rest of my model. You could use this for like a loss to lease kind of an analysis, but honestly, I don't pay too much attention to what the current property manager is identified as market. But what I look at is pro forma. So pro forma renovated, I go through and I determine what my pro forma rents are going to be. And you can see that the increase here of dollar and percentage. So you can see that there's a heavy lift just on the Tahoes. The reason that the Tahoe units have such a heavy lift is because they're very unique. They're actually two-story townhomes, one bedroom, 1.5 baths. So the bedroom is up on the second floor, taking up the entire second floor. It's very desirable. The turnover on this is very low, and it leases very quick. So when these units come available, it instantly gets taken out. So that is a clear sign that these are under marketed and a great room for taking the opportunity to capitalize on that. And this just shows the unit mix across it. So how I go through my pro forma renovated numbers is by rent comps. So we do a rent comp study, and so I go into CoStar and I basically download all the available comps that are in the area, and you can see that this is the subset of um, uh, comps that we're using with all within like a 2 mile radius of our property. So I throw it in a table here. I look at it from basically, and in case you didn't catch this, the Pinnacle is the current name of the property, and we're renaming it and rebranding it as Atlas at Lewisville. But So Pinnacle, you'll see that name kind of pop up throughout the underwriting. But what I do is I look at what's the current rent per square foot, the average rent in place, what are one bedrooms, two bedrooms renting for, and the overall occupancy, any concessions that's being offered. And this is all based on CoStar data. And the real data is actually going to the properties and verifying these, which is part of our due diligence process that we do. So you can see here that the Pinnacle current in place rents are at 1255, one bedroom at 1140, two bedrooms at 1400. And then I look at the averages across the subset or the comps, and then I look at the top five. How is the top five performing? So the average is at 1300. The top five is at 1500, and you'll notice that the Pinnacle is actually below for both cases. Then looking at it from the one bedrooms, 1100 versus the 1200, two bedrooms, 1400 versus 1500. And so looking at kind of a more of a breakdown for what our pro forma is, using basically 1200 for the pro forma of one ones, 1400, kind of looking at the averages here between the 1300 and 1500. So these are again are the a lot of these are the townhome units, which we're not at the top. We're not at the top of the market compared to the top five. We're still below that. So there's still some room to grow. And that's kind of like the initial conservatism that I start to build into these models. And then for the pro forma at 1500 and 50, and we're still below the top five. So that's how I kind of initially do my um, pro forma rents. I look at the comps, I look at the averages, I look at the top fives, and just kind of see where we want to be. And I set myself below that. The reason I set myself below that is because I want room to grow, and I want the option in case there's a turn in the market or anything like that, that we can actually reduce our rents and compared to the market, and still maintain that traffic and interest and keeping our occupancy high. So I'm below basically the averages. Then what I do is I break it down even further and I look at what's been renovated, what's versus classic, and making sure that we are truly comparable to those rents that of those classic units versus the renovated units. And so that's how I dive into it a little bit more. We then go and drive these properties, we tour them, we look at them, we compare notes, and see that yeah, there is definitely some room for us to improve on our units, and then where the rents are, and looking at it from a perspective of a tenant. So once I go through all the comps here, then basically going back to the inputs page, that's where I enter in my pro forma. So 1300 on average. And then this is where I basically do the renovations in the mark to market. So, currently in place on the renovated units is 1300, where it could be at 1200. So it's a modest lift. And so it's looking at a zero or $61 rent premium. But I want to round this up, and you can see that I'm doing a roundup of only 90%. So I'm assuming that I'm able to get 90% of these units up to basically my pro forma. The remaining 10 is going to stay at the in place. So that's another layer of conservatism that I add into my underwriting. So I don't bump up that all the way. On the renovated units, so I do take it up to, so I want to renovate all the units, and bring those up to basically market. So I still leave a little bit of buffer in the renovated ones, and take the advantage of the rent. So it's showing here that out of the 150, only 140 are basically being increased. The remaining 10 is going to stay at what's in place. Okay, so now we look at the timing assumption. So renovations are going to be again in month four, and this is driving basically when those rents can start increasing in when the vacancy for renovations happen. So renovation duration is 1 month, and then remarketing duration, I put it 0. Basically, what our plan is like the moment the unit becomes available, we want to already be leasing that for the following month. So we have, less than a month to get these renovations done. The renovations are very light. It's replacing the countertop, LVP flooring, new appliances, and basically some paint. Very light and easy to do within just like a week, maybe two. So we're able to release these immediately. But so I've assumed within the model, excuse me, it's going to be 1 month. Uh, and then as far as the velocity, so if you go back to, if you remember the rent roll here, and I'm looking at the lease renewals, we've got uh, here on, we're looking at an average of basically 10. So we do feel that there is some current units that we could jump on, get those renovated right away, and then renovating or upon the lease renewal, that's when we're going to be increasing those. And remember, there's still a buffer here as well. So some of these won't get marketed. That's the ones that are going to stay behind. But then that's where the renovation or the markup happens, basically 13 units a month or that lease renewal. Um, so then now we get into basically the CapEx. This is where I break down basically the CapEx underwriting. So 17 units, you can see up here 17, 6, and 12. So 17, 6, and 12, each with a budget of 10,500. So I have a detailed calculations tab here where oops, sorry, wrong, CapEx, where I go through and I see, okay, what needs to be done, what's classic, what's renovated, and what's part of the component. Um, and I already have basically pricing here for what these things typically cost us. So I go through and I say yes, no, what's needed. And then it comes out to basically, what is our cost for a 1-1 comes out to 8,800, for a 2-1, 10,000, and a 2-2 of 10,350. I check all our prices too through Home Depot and continue to update these. So here's all the links that I have for Home Depot, and just making sure that all my prices are still accurate. Um, and then of course get pricing from uh, local contractors and property managers. So, but you can see here that my estimates are coming below 10,500. So I've put in here 10,500. Now, when we walked the property and we actually went through some of these classic units, it's very light. And really, I think it's going to be about 4,500 for some of these renovations, because the units they're not like classic like you would think. It's like I said, just new countertops, maybe new cabinets, flooring, and a paint. But we have a healthy budget of 10,500 for each, so that at least it's accounted for. And we've also have walked around the property and identified things that should be addressed, like parking lot, irrigation, and drainage is definitely something that we need to address right away. So we have had additional cost here for drainage issues. Uh, Touching up and painting on the exterior at all, roof maintenance if maybe, um, power washing the property, HVAC. We've got $150,000 for any HVAC. That's including the ACs or hot water heaters. The hot water heaters, they should be replaced, at their lifespan of like the basically 10 to 15 year range. So we've got a nice budget in here just to pay for those hot water heaters, and then any miscellaneous stuff. So we have basically a total CapEx budget for the exteriors of 484. And then we've got some money set aside for additional playground equipment We're buying washer and dryers, 150 of them for $1,000 each. And then adding in private backyards. There's 25 units that we could add in a private fence, add a backyard, and it actually increase the premium. So all in CapEx at 1.1. This is where I get into the debt structure. So, what we've been quoted from CMBS is a 5-year fixed 75% LTV based off of the 5-year treasury. So the last time I looked, June 16th, it was at 4.15. So I'm using an index floor of 4.3. So being a little bit more conservative on the index. So in case there's any movement over the next, say, month, before we close, that there's some buffer there. The spread that we were quoted is at 1.76, so our all-in rate is at 6.06. That could actually come down by the time we close, but because of the index floor, so at least 6.06. 5-year term, 60-month interest only, so that's 5-year interest only. We've got a 1.4 origination fee, so that's 235,000. 75% LTV, a 1.25 DSCR. Sorry, so I did say 1.2 earlier. I'm correcting myself. It's 1.25. 1.25 on the minimum, and the minimum debt yield is 7.25. Replacement reserves, and so basically, we also are doing a rate buy down of $345,000 for a total fee of 580. So I've got that built in here. So 75% LTV is 17.25 million. 30-year AM, 60 months of interest only. So at a 6.06, and with the 1.36 financing fee. I have the rate buy down right here. So rate buy down fee 345. So when you add these two up, it comes out to 580. So I got that covered within the model. You can see here that the T12 DSCR clears that minimum hurdle of the 1.25, and then our year one pro forma projections are at 1.19. So we are below that. So that's highlighted there in yellow, but that's because of the major renovation vacancy that we're assuming, which really won't take that long to do, as I explained earlier. Okay, so explain the debt. Now the sources of cash. So we've got, I'm going to delete that. Doesn't no longer needed. So sources of cash. So 17.25 is the senior debt. LP equity of 8.9. Again, our sponsor equity is being contributed as LP equity. We're putting in about $300,000 into this deal from the whole GP team, probably more. So then the uses to purchase the property at 23 million, financing fee, which is that 235, which you see right here. 420,000 is our closing costs. So I've got my closing costs here. It's set at basically $420,000, but I went through all the expected costs that we can possibly occur. Anything from opinion letters, our real estate attorneys, to lender costs, lender's insurance, appraisal costs, real advice, which is a tax attorney, looking at all the closing and escrows, and then travel costs, other due diligence costs for the GP partner. And so if I zero that out, it's 289. So, I think we're going to be about $300,000 at the end of the day. But my bare minimum is at 289. And then we're at basically 1.83, so 420. So we still have a little bit of buffer there too, in case there's any unexpected closing costs. So $420,000 there for closing. Our acquisition fee of 690. Interior capex, exterior capex, that adds up to that 1.1 million. And then we've got 3 months of reserves. It's always great to have reserves, for unexpected items that come up. So we've got 3 months there, plus our capex. I think we're very healthy with the reserves that we have in place. And as we get into the property and operations, if we feel that we're cash heavy, we can make an early distribution. So that's the positive sign of being on the cash heavy side and being a little bit more conservative. So with our rate buy down of 3% or 2% rate buy down, sorry. Okay, now going into the assumptions. So I already talked about the vacancy losses and the economic losses. Now let's get into the rents. So CoStar, like I said, they're a good tool to use and use as reference. But a more accurate tool that we have found is RealPage, another analytical tool that looks specifically at this property, the submarket, and the entire DFW metro. And I'll pull up actually what they provided. So this is all the trends. I'm going to actually delete this table there. So they look at year over year effective rent, change, effective rent, occupancy, concessions, revenue change. So this is all the information that's provided from RealPage, specifically for this property. And so this chart basically represents, where the rent growth has been over the last year, which has been negative. The same in many markets across the U.S. But where this property is at, you can see that it's gaining positive momentum through Q4 of 2026, and then growing up above 3% in the coming years. This trend line right here represents Atlas at Lewisville, and then this is the submarket rents and where it's growing, and the DFW market rent. So we could see there's still a loss to lease that's shown here, that we still have movement to get to that point. And then so you can see over the next year, the rents are going to be 1.5 to 2. The following year is at 2, and then up to 3. So we take that information. So if I go back to inputs, looking at the organic rent growth, and then using the data that I was taking from RealPage, seeing that on average it's about 1.9 for year 1, 2.5 for year 2, and then I'm capping it for year 3 at 3%. So if the market does continue to outperform and shows what and does what the RealPage suggests, of going more than 3%, that's a win. That's better overall cash flow for the project. So that's just another level of conservatism that I add in there. I always want to make sure that I'm not hitting past that. One of the things that I mentioned before was about the loss to lease and my theory on loss to lease. So, others use loss to lease when they look at their pro forma rents at the top of the market. And then they factor in a loss to lease on, typically what they see. I don't like doing it that way. That's just another variable that can skew basically data. And so I like to use as less or the minimal amount of variables within my underwriting. Loss to lease is just one of those that is it's to me it's unnecessary. It's great when you're looking at when you set the rents as your market rent as a property manager, and then you've got that hey, we're at a say 2% loss to lease. The next month it's 1%, and then the following month it's at 0. That's a good gauge for you when you're operating a property. But when you're underwriting it, it has no meaning. Like to me, it has no value. So it's just another lever that makes it confusing. So I set my pro forma rents below the market, below what is actually happening in that market today, and I assume basically 0 loss to lease because it's already kind of factored into that amount. So that's just my opinion. I'm happy to debate it, but that's why I set it all at 0. Okay. Other income growing at modest 2%. And then year 1 expenses, I set it at 0 because first year of expenses are pretty dialed to what is currently in place, and then growing it at 2.5%. For real estate taxes, this is a wild card in any market. Same with insurance, but Dallas is pretty, insulated compared to like other markets like Houston or Tampa, which have hurricanes, and so insurance could be wild. So I would actually increase these numbers for insurance in those markets. But Dallas is, doesn't have those types of natural disasters other than probably a tornado. But real estate taxes is the other one that's kind of a wild card. So I assume at 3.5%. Now let's look at taxes. So taxes, I'm assuming or first of all, let's look at what's been happening in the past. So the assessed value at 18 million did get up to 20 million at one point in 2024, which is when this property was purchased. And then before that, it was below. And so I could see what the millage rates were here. This was based on all the data that I could collect that was available on the assessor's website. So I could see that the millage rate, say somewhere between 1.7 and 1.73. And currently, what the millage rate is in Denton County is about 1.72. And so I'm taking the acquisition price of 23 million using an assessment of 90%. So it comes out to 20 million for the year one taxes at 356. The good news is that this property was just assessed April 10th. And it was assessed for basically 18 million. And which was less than so 18.6, 18, yeah, less than what was initially on the website. So it came in less. That means the tax bill for the next year is going to be less than 321. I have 356 from basically day one. So if I look now, coming down here, real estate taxes 356. That's starting at day one. We're the current owner is paying 317, and it got assessed at basically that same value. So right there. There's already a bit of a savings. But I'm already increasing it at 3.5% year over year. Okay, so now talked about the rent gross and assumptions, and now let's kind of get into some of the other details. Um, Miscellaneous income and fee income and utility income. So what I like to do, going back to the T12, I like to look at miscellaneous income and fee income, RUBS, all the other additional income, and I like to break it down a little bit further. So you can see here all these items right here. These are coming right out of the T12. So I can see based on total unit allocation of 100%. So this is on average across the property. What's being charged for the utility fees, pet rent, amenity fees. And so looking at what this property is already receiving for income. And then what I do is, okay, I see there's probably some opportunities, like washer dryer income, adding in the private yards, and then looking at the carports. And so you can see the percentage of allocation. So we already have some units that are being using washer dryers at $50. I'm taking it up to basically $65. And in using basically that market. So 17% and then the 83%. But I'm not doing it on day one. You can see that it's ramping up here, and I'm ramping it up over the year. So starting at 8.3%, this is just a calculation that's showing what's going on and how it's allocating it. So starting in month two, we'll have 8.3% of my plan that's now starting collecting these income from the washer dryer. And so that ramps up over basically the full year. Same with the private yards. We add in these private yards and it slowly ramps up over the year. Same with the carports. Making sure that we're charging $50 a month. And this is actually less than market. Some of the other properties are at 65, 75, even up to 100 um, for some of their carports. So we're staying below that market at $50. So that's where the additional income is starting to come in. So we look at this, we break it down, we compare it to the actual rent rolls, and making sure that they're being allocated correctly, and then doing our performance. So you can see here, based on just what's in place, 269,000 here, and then what we are increasing is up to 274,000. So 269 to 274, and then adding in the remaining items, so like the washer dryer income, private yards, and carports. Uh, For miscellaneous income, that's basically still maintaining the same kind of velocity in relationships. These are basically like lease renewal fees or application fees, other fees that the property charges, and so you could see basically anything that says miscellaneous, so locks and key, fines, other income, damages. Um, so these are variable every month. But this is typically what we've been seeing, and we look at the trends over the year, and just decided to keep it in place as is. Now we look at basically the operating expenses of what's controllable. That's repairs and maintenance, payroll, marketing. So went through what's currently being charged and what we think, and we also met with our property manager to get basically a budget for all these items. So we went through all the contracts, and what our turnover costs are, what the landscaping contracts are. Um, Breaking down the payroll. I've got payroll down here for detailed calculations here, and what we're looking at. I also got contract services, what's currently in place on contract services, what is currently a marketing and advertising budget, and then administrative costs. So I go through my initial kind of estimate and underwriting, and then compare that to what's in place on the T12. So you can see, many of these things are kind of matching. So and the reason that if they are matching, it's meaning that their current in place operation costs are higher than my estimate. So I went with a more of a conservative number, versus like marketing and advertising, for example, 302, and I bumped it up to basically 365, taking it from the detailed calculation. Now, the one variable that you see here is the payroll. So the payroll, I estimated a lot more initially, but they're currently at 1920. And even talking to our property manager, who's put together basically a budget for this property, they're also at 1920. So I used their number because of what they provided me on for payroll. I was getting a little too aggressive on where salaries are and details like that. So like salaries for property manager. I was also heavy on the number of staff. Probably don't need four full-time people, maybe three and a half. So I was definitely aggressive. Same with the bonus structure. And I was taking basically my information from other properties in another state. So it was an apples and oranges comparison. But I did get these numbers and verification from our property manager, so I'm comfortable with that because that's what they provided us. So utilities are pretty much in line with what's there. No change to that utility. Um, Property management fee, that's at 2.5%. Insurance, that's another wild card that usually comes up. So it's shown at 721 or 108,000 a unit. So we did get quotes from our insurance companies, and so $104,000 or 695 a unit. So this is what we've been quoted, and this is what we're working towards, 104. So we're slightly below that. We're pretty much in line. So kept that the same. Was happy with that, and of course, adding in the replacement reserves. So looking at the total operating expenses of 1.2 in my underwriting, and then taking what our property manager has provided us. So if I look down here, uh, total operating expenses, they're assuming for the next year, 1.14 of total operating expenses over the next year. So they're probably a little bit more aggressive than me, but that's fine. My underwriting is higher, and I'd rather have a little bit more of a cushion because that's risk mitigation that I look at from when I am doing my own underwriting. Okay, so covered basically the breakdown, the rent roll, the unit mix. Talked about the CoStar reports and how I look at that and use the data. Went through all the rent comps, the T12. Talked about the detailed calculations and how we're looking at ramping up other costs. Talked about the capex. Talked about closing costs and taxes. Also included in my uh, monthly pro forma is obviously the monthly cadence on how this is all working. One thing I also like to point out is under the detailed calculations, even though this um, additional income item is assuming on 100% of these units, it's still factoring in the losses, so the vacancy losses. So even though it's showing like $28,000 there, the vacancy losses is still applied to that overall, because obviously when you don't have a tenant in there, you're not going to be receiving that additional income. So that's also built into the monthly pro forma. Annual pro forma then takes basically everything from the monthly pro forma, looks at it on an annual basis. Where we're performing for our even with our senior financing, any preferred equity if we had any, but we don't. Our asset management fee that we're collecting, how that works, um, and then basically the waterfall. So this is a sponsor LP waterfall and sensitivities. So I don't need to go too much into the waterfall, but the waterfall is basically saying like how basically the flow of money works. So 8.9 million equity, and then the return of capital each and every month. So how that's all working up until we sell the property here. So you can see the sale of the property and then the distributions. So how this waterfall basically works is it goes through each tier. So tier one being the 8% pref. So the investor balance, here's the balance, here's the accrual that is happening with that 8% pref. So you can see it takes the balance times the 8%. And then what has been distributed and creates a new balance. So it does this every month. It keeps track of the accrual that's happening each and every month, and then adding that to the balance until that balance is basically paid off, which happens at the sale. So everything is paid off. Once that is paid off, then we start to get into basically the other tiers, and how now the sponsor promotes happen. So everything, 100% of the remaining cash flow goes to the investor, until the 8% pref has been paid. And then once that 8% pref has been paid, then we look at the 15% hurdle, and then it's 70-30 split. So this just divides it a little bit more. And then remaining cash to distribute, 288,000, and then it does the 50-50 split if it was over that 15% IRR hurdle. As far as sensitivities, so let me turn this on. Normally I have it off because it does take up a lot of power when running these things because it's constantly being updated. But I turned it on. Give me a second. I'm just going to pause the video while oh, there we go. It's a calculated it. So this is basically if I come over here, this is our basis. So we're selling it in 5 years at a 5.5 cap. So 15.2% IRR, 18% average annualized return, 6% cash on cash, and a 1.9 equity multiple. So I look at these different stress tests. If we're selling it for shorter duration, longer duration, uh, different expansion or compression on these cap rates. I also look at NOI changes. So our base case NOI and a 5.5 cap sell gets us to basically 34 million sell price. That's within the model. But then I look at it like, okay, what's the worst case scenario? So we're basically taking a 10% increment on NOI from the suboptimal, which has already been reduced by 10%, so 20% on the NOI, and looking at it at a higher cap rate from 5% to the 6% here. Give it a second. It's calculating. This is always the fun part of dealing with these tables, and sometimes it takes a lot of brain power to calculate. 1 second. I'll just pause while it works. Okay. So yeah, so basically at that 20% discount on NOI with a higher exit cap, we're still at above the purchase price. At least we're okay as far as selling it above the price that we purchased it for. And an optimal case, 10% more out of 6%, we're still above the exit price that we're looking at. So this is one way of we looking at the stress test. Also looking at a DSCR stress test. If our interest rate's fixed, but if we were able to reduce the interest rates to 5.7, we get the year one at 1.25, and then if interest rates climb up to 6.5. 6.75 by the time we close, then it's a DSCR of 1. But this is on the year one, keep in mind. Doing operational stress tests on basically looking at like a 19% change for operating expenses, for example, and looking at the available cash flow. So what I did is looking at year one. If our operating expenses increased by 19% and our effective gross income stayed at 0, but our operating expenses increased by 19%, that means that we would have 0 cash flow. So it's going to take a lot to get our operating expenses up 19%. So still feeling very comfortable that there's still going to be enough cash flow to distribute basically in year one. No refinance. This is a refinance stress test that I did. The easiest lever for us to look at when it comes to sensitivity analysis and stress tests upon sale is a cap rate expansion, which is what I did in here, right? So that's the easiest metric. You can break it down further and pull all these levers and looking at all these different scenarios. But the one basis that never really changes in the model is a cap rate. But to take it a step further, I did look at like a refinancing stress test. So looking at if we wanted to refinance versus the cap rate expansion, making sure that if we refinance in year 5, instead of selling in year five? Are we still below the 70% LTV? Are we still able to carry the debt service? And so basically the scenarios that I did, and even looking at a higher interest rate, our break-even occupancy on a 7% interest rate, or even a 7.5% interest rate, and a refinance interest rate at 7.5, our break-even occupancy is at 80%. Our DSCR is at 1.2, and so we still got plenty of coverage. When we look at basically the exit cap, so like refinancing it at 150 basis points or 7% exit cap, looking at the NOI, um, and what the paying off the loan, current loan, and seeing that there's a surplus of equity here, we're still at basically an LTV of 63%. So it meets all the hurdles. We're still insulated from any downside or upside, or especially the downside. If we had to pivot because there's a complete change in the economy. Uh, Waterfall we talked about. So the overall returns. This is basically a summary of the investment. So at $100,000 investment, the cash flow distributions, and that all comes from this waterfall calculation. Um, 1.6, 5.8, 7.14, 7.68, and 7.5. That's the distributions. With the return of capital at 100,000 plus the promotes of 62,000. So a total return back is 109. That's how you get your equity multiple of 1.93. So that's a deep dive into my underwriting. Of course, I could talk for hours about each of these items and details, but I'm sure you don't have a whole lot of time to sit there and watch me do all this. But happy to answer any questions that you may have regarding the underwriting. The underwriting model is also available in our deal room so that you could actually look at these numbers and kind of see how it's built and more of those details. So happy to answer any questions. I'm glad you stuck with me through basically an hour and 20 minutes here, and look forward to working with you all on this deal. Thanks.